Hello and welcome to this week's episode of CoinScrum Markets. I'm Nisa Amoyals. Coming up, Jesse Proudman returns to review the markets in Crypto RFQ. Emmanuel Gauss, CEO of market infrastructure firm Skew, joins Tina to discuss their plans following their recent raise. Alex Batlin is joined by Melonport founder Mona El Issa and Diversify's Daniel Yanev to discuss the gaps that will need filling if DeFi is to cater to a professional audience. And James Bennett is back to analyze this week's on-chain data in On-Chain Reaction. First, a look at this week's blockchain industry news. SGX, the Singapore Stock Exchange, has announced its first digital bond issuance with HSBC and sovereign wealth fund Temasek for agri-food giant Olam International. The pilot exercise replicated a $400 million 5.5-year public bond and utilized the DAMO smart contracting language. And in a sign that they believe that public blockchains also have a strong future ahead, SGX also announced the listing of their first ever crypto indices for both Bitcoin and Ethereum, launched in partnership with UK-based Crypto Compare. News was mixed for Bitcoin miners this week. In China's Inner Mongolia region, leading mining hardware manufacturers Bitmain and eBang were amongst 21 mining firms to be disqualified from energy trading activities by local authorities, a ruling that could see their energy costs pushed up by around 50%. Things were more positive in the US, where mining firm Crusoe Energy announced a partnership with the Norwegian energy giant Equinor to convert flared gas produced at their oil fields into electricity at source for mining Bitcoin, and leading crypto investment firm DCG announced the launch of a new subsidiary called Foundry that will target opportunities in mining and staking. With current central bank policies keeping inflation concerns front and center, a survey by peer-to-peer crypto trading platform Paxful has revealed that 3 out of 4 Argentinians consider Bitcoin and other crypto assets to be the safest way to invest during these uncertain times, with Paxful seeing a 37% increase in local trade volumes this year. Although decentralized exchange volumes hit an all-time high in August, with $11.6 billion of value being traded, Ethereum founder Vitalik Buterin once again attempted to turn down the heat in a series of tweets that likened yield farming to central bank money printing, saying that he's staying well away from it. Finally, as government agencies continue to notice certain benefits, the public nature of blockchain transactions, crypto intelligence firm CipherTrace announced this week that it has developed a toolset for tracing transactions on the privacy-centric Monero blockchain. Developed for the US Department of Homeland Security, the firm said that exchanges and trading firms would also benefit from knowing they aren't dealing with tainted coins. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ. I'm delighted to be joined again today by Jesse Proudman. Hi, Jesse, how are you doing?
Very well, how are you?
Good, thank you. So what's happening in the markets this week?
Yeah, we had an interesting sell-off again last night. This 12,000 Bitcoin price level is obviously showing some pretty strong resistance, which I guess is to be expected given sort of it's acted as a historical resistance line over the last 2 years or so. We've talked in the past about needing to break through that and hold a breakthrough through that for a number of days before we can really consider that support instead of resistance. So interesting to see that big sell-off. The more interesting thing to me last night, though, was sort of Ethereum leading that drop. A lot of sell-side pressure onto the Ethereum asset class, and I think it's given Ethereum's sort of meteoric appreciation this year, not totally unexpected. I think we've got a lot of market participants who are heavily levered long in that asset class, combined with a lot of purchasers as a function of sort of the rise of DeFi over the last couple of months. So I think that there are potentially folks that are a bit over their skis at the current price levels. So a pullback not totally unexpected, but it's certainly been a fascinating 24 hours.
Well, in relation to Bitcoin, some of the analysts tried to explain it as, well, it is indeed a safe haven asset again, because, you know, the other risk-on assets are moving in the other direction. What do you make of that argument?
Yeah, I think it's hard to quantify Bitcoin in relation to the traditional financial ecosystem. In our perspective, it stands alone, sort of outside the traditional financial ecosystem, and it does so because the market participants are largely interacting with this asset class for very different reasons than they buy gold or they buy sort of other risk-on hedge investments. So for us, folks are involved here because it's a new technology, it's a different technology, and it's a different monetary hedge than sort of what has existed. And so we sort of think of it as its own entity, and we don't think about it in relation to the traditional financial ecosystem.
Now, when you say people are over their skis in DeFi, how are you working on mitigating those risks yourself?
Yeah, so our fund does not actively trade in any of the sort of DeFi assets today. It's certainly a space we've been watching very closely. There's a number of issues that we're concerned about, starting off with the fact that sort of the mania and the price appreciation happening here over the last 30, 60, 90 days really is reminiscent of the 2017 ICO bubble. So it's just sort of, it feels very similar to that movement where you have a lot of capital flowing into untested ideas, and which is not to say they're bad ideas, but they're just new and nobody knows how they'll play out. And then I think that the really interesting component here is that this movement, this whole DeFi movement, is the first time we've had all these interweaving smart contracts, and nobody really understands sort of the risk factors there, particularly when it comes to Ethereum's price point. So a lot of these contracts within the DeFi ecosystem use Ethereum as sort of the collateral for a lot of the lending, borrowing, derivatives offerings, et cetera. And they rely on the ability to liquidate that Ethereum should the price fall to be able to cover user balances so that nobody loses capital. And I think the interesting thing here is we're at a point where the gas price on Ethereum is so high that it might not be possible for a lot of these smart contracts to liquidate their holdings fast enough to sort of deal with a material reduction in price in Ethereum. So if we go back and we look at sort of the events of that second week in March, where price fell dramatically over the course of a couple hours, we had the ability, a lot of these protocols had the ability to go liquidate their assets, and there were sort of one or two occurrences where that wasn't the case. But in this scenario, the network is congested, and the network is congested because everybody's actively using it, using all these protocols. And so if we see a material impact in price, I think there's a lot of unknown with what could happen with all of the billions of dollars that are locked up in these lending and derivatives platforms.
Yeah, absolutely. And what do you think about the fact that we call it decentralized finance, yet there's only a few select few who can afford the gas fees or who can afford to invest in it? You know, when do you think that'll open up?
Yeah, I mean, so Vitalik had a great tweet yesterday talking about gas fees and the entire notion of sort of the auction market. You know, to me, the fact that it's called decentralized finance and yet many of these protocols are sort of owned and operated by centralized parties or individuals, that's the more interesting and sort of comical component of all of it. It is on chain. I think there's really some compelling and fascinating elements of the fact that it operates on chain, and we even saw that with Hester Peirce commentary yesterday or the day before, talking about the fact that DeFi sort of exists outside the realms of traditional regulatory framework. Like, it's going to take some additional thought and consideration from a regulator's perspective on how to look at all these things because of that smart contract based nature of all of this. But yeah, there's many sort of interesting components here. Certainly, the gas is a big part of it. At the price point we're at, it means you've got to be moving material amounts of money to sort of compensate for the costs of executing all of these contracts. But it's a work in progress, right? All of this has been an experiment and a work in progress over the last decade, and Ethereum and Vitalik and the entire Ethereum Foundation certainly are aware of the capacity limitations of the network, and it's something they've been working on for quite some time. We've got Ethereum 2.0 sort of around the corner, which I guess is been around the corner for a while, but
yeah,
right. But we're getting closer. So at some point here, we'll see that platform launch, and that should have hopefully a material impact on fees. And at the end of the day, this is all just a big experiment, and everybody's sort of figuring out what works and what doesn't work, and where we need to fix components of this technology.
In the meantime, the lawyers are getting very excited. So
and very rich.
Yeah. Thanks, Jesse. Thanks so much for joining today, and we'll speak to you soon.
Great, appreciate it.
Compared to not even 2 years ago, the toolkit for professional traders and investors looking to access the crypto markets has moved forward in leaps and bounds. London-based Skew are one such company leading the charge with a keen focus on the regulated derivatives markets. Tina was joined by Skew's co-founder and CEO, Emmanuel Go, to hear more about what they are building.
Thanks, Nisa. I'm delighted to be joined today by Emmanuel Go, co-founder and CEO at Skew. Emmanuel, thanks so much for joining us today.
Yeah, thanks for having me. It's a pleasure.
No, it's great. So let's talk a little bit about Skew. Why did you start the company, and what problems did you foresee when you started the company that you were trying to solve?
Yeah, so we are actually turning 2 years old this week. We started the company in September 2018. We are a team of 16 people right now. We are all based in London in the UK. So before starting Skew, I was a trader at JP Morgan for most of my career, and I was trading single stock options there. So I've been working in the markets. I think joining, arriving in London in the first place in 2009. So I think for me, we've seen a lot of growth, I think, in the technology sector. That's really like what the last cycle is about. And at the same time, I think I've spent a lot of time working at a very large bank, and I haven't seen as much innovation, I think, in terms of really leveraging all those new technologies to build, I think, better products. So I think today, like for a large bank, updating Python from 2.7 to the next version is gonna be like a multi-month, if not year, project, to give you like an idea. So I think we looked at crypto. So we saw we are late mover to crypto. I really looked at it in 2017 when we had the big boom. So in a way, we are a bit like, I think a lot of the talks, especially at the end of 2017, were about institutions entering the space, which was primarily dominated by retail initially. And I think we are part of that trend. So I work all of my career on really the institutional side, like servicing very large institutional clients when I was at JP. My co-founder was doing the same at Citigroup. And then on the engineering side, we have people that are coming from all the large banks, from Goldman to Morgan Stanley, UBS, Citigroup. So I think we, that's probably like a good half of the team. And then some other people have been actually doing, especially in our front-end team, just developing products for these large corporate clients. So I think we really have that in our DNA, and I think it shows in our product in terms of we are really kind of targeting those clients that we used to serve on the banking side. So that's really, yeah.
So let's talk a little bit about these institutions. So the recent Fidelity survey that came out indicated that there's a strong growth in institutions wanting to gain exposure to Bitcoin via the CME futures, for example. And many of these firms will already have clearing relationships in place to enable that access. So what benefits do your institutional clients gain by accessing CME via Skew? And what features are in the pipeline that are unique to crypto? So you're saying you're kind of a late arriver.
Yeah. So that's a good question. So just to come back a little bit, I think we see crypto as this industry with just a lot of potential, really, and I think it's still very niche and it's got a lot of room for growth. And so, we have crypto, it's got a lot of potential, new asset class, a lot of room for growth, and then you have the very big world of finance, which is very, very large. And so what we are trying to build is really that bridge, that front end of crypto for institutions, so that they can embrace that new asset class like they did before with commodities, for instance. So we have two products. One is a data analytics platform, where you can see in real time those very, I think, fragmented markets, and I think initially also markets where the quality of data was not even very easy to assess. So I think we are doing a lot of work there, and we are trying to position ourselves as a leader for the products that really matter for institutions. So that's futures, options, and we recently kind of upgraded our coverage to the spot market. So we start to see more, we have more than 1,000 firms that are signed up on the platform and are using us to track the crypto markets on a daily basis. So what we think from there is that, most of them actually are really, I think, in what I call the homework phase. So they are not ready just yet to consume and enter crypto markets, but they feel like there is a need really to get a better understanding of how this asset class is going. So, what we think is that from there, some of them, maybe a lot of them, will want to start consuming those products. And so what we want to give them is a way to do it from our platform, so that you really kind of side by side, all you need to kind of enter enter this market. And so what we are trying to do here is really do something really clean with the workflows that they are used to, where, we are mindful of things like, credit risk, because, institutions, they are very mindful about that. What is our regulatory setup? Do we have any conflict? Like, do we trade on our platform? We don't. What sort of products do we make available for them? So really, we've kind of tried to think about that from the ground up. And so that's where, when you think about CME, CME is the largest derivative exchange in the world. They are home to the S&P Mini futures, which is really the bread and butter of futures market for anyone that's been, trading equities at least. And so it's a very natural choice, I think, for people. I think they have already to answer so many questions about, is crypto dangerous and why crypto, that it makes their life easier, that at least they are trading in a framework that they are familiar with. So what can we bring here? I think, historically, when you look at the futures market, most of the trading activity is going to occur directly in the order book. But when you go into products that are a bit more complex, like options, you tend to see that liquidity and the trading starting to occur off the order book. So it's kind of negotiated outside and then reported to the exchange. So our trade execution platform is essentially an RFQ service where you can be connected to a number of market makers to get a price, get liquidity, a good price for CME options. And then we're gonna report it on the exchange so you don't have to face us in terms of clearing.
And what are you guys doing around capital efficiency? How do you envisage users trading across both these regulated platforms and, potentially crypto native derivatives that aren't regulated on unregulated platforms?
So, not all the firms have the same requirements, I would say. So some of the prop trading firms are kind of lightly regulated or unregulated. Usually they are managing their own money. So in a way, they can do pretty much what they want.
Mm-hmm.
And so, they will tend to show preference for the more kind of what we call offshore venues, where you have more of a retail flow and potentially also access to more leverage and margin, which is making the whole thing more capital efficient. When you talk to a bank, the story is going to be a lot different. They will already face, I think, a lot of questions just to trade the CME contracts.
Sure.
It really depends. I think, in my mind, they are kind of, we are building the bridge between crypto as an asset class and traditional finance, but this bridge kind of works both ways. And I think there are really like two buckets in my mind of potential customers. There are really, those large institutions where we want to build like a platform that makes sense to them, and the crypto native firms. And sometimes, those firms are going to want to increase their exposure to the traditional side of things, where we can also help, especially on the analytics side.
So how far, understanding your clients' appetite and, their risk appetite and, their adoption appetite, how far away are we from firms with high regulatory requirements like banks being able to seamlessly trade CME Bitcoin futures? And within indeed that kind of crossover in the unregulated derivatives and so on?
That's a good question. It takes time. I think we are definitely in this homework phase, and so there are probably a number of firms that have already put in place the right infrastructure so that if they want to move, they can move quick.
Mm-hmm.
But my view in there is that there are a lot of people that have done now the homework for a little while, and what you need really, I think, is the push on the client side. And I think this push on the client side is really driven by price. And because I think crypto is this asset class that's very new, that is, to be frank, quite complex to comprehend. And so there are a lot of people that would feel more comfortable if it would just disappear, I would guess. So,
sure.
So you need price basically to force them a little bit to revisit the asset class on a regular basis. And I think, there is really this level of Bitcoin, the previous all-time high, which was at $20,000. And I really think that, if we get there again and break out, then the clients will ask a lot of questions all of a sudden at the same time. And that probably kind of, give enough, business case for some of the banks to say, okay, I think now we can do it.
Yeah.
So it's far and close at the same time, but I think it's all you need is I think just a little help from the market.
Fabulous. Well, and I think one of the things that institutions do have a requirement around is that clearing. So I expect that you guys are looking at that clearing challenge as well as crypto evolves. What role does Skew play in that part of the field?
Yeah. So our view, and that comes back to this initial point of leveraging great technologies to build better products, is that it's the best time probably to build a fintech. Like, we don't have to reinvent the wheel for every single time for everything. So what that means is that we don't want to be a custodian or doing clearing or collateral management. That's not what we want to do. We want to actually leverage some of this infrastructure that is really hard to build and usually is heavily regulated and requires a lot of capital, and just build on top of it. Mm-hmm. So, I think that's pretty clear in our mind, and I think that's why we've got very good relationship with most of the exchanges and custodians out there, and because we are just a good partner.
Fantastic. Emmanuel, thank you so much for joining us today. Fascinating conversation.
Thank you.
Back to you, Nisa.
As exhilarating as the recent DeFi ride has been, it's apparent a lot of work still needs to be done before institutions are able to jump in. Starting out in 2017, the Melon Protocol and Diversify are two early DeFi projects that had the needs of professional participants in mind from the very beginning. Melon's Mona El Issa and Diversify's Daniel Yanev spoke to Alex Batlin this week to discuss how they intend to bring DeFi to a wider audience.
Thank you so much, Nisa. We have two really amazing guests. Mona is from Melonport and Avantgarde Finance, and Daniel is from Diversify. Mona, would you please tell us about the amazing Melonport project?
Sure. So so it's been a while now. I first got into this space 6 years ago now, and it was really after quite a long time in traditional finance. So I started my career in London on the trading floor of Goldman Sachs. I was market making there and prop trading for nearly a decade, and then moved to the buy side and worked for a large European hedge fund running long short equity. In 2014, I was offered some seed capital to launch my own long short equity fund, and I was extremely excited about that, jumping up and down at the opportunity, very naive too, and took this opportunity. It was a $20 million seed, so it was pretty small. And that was probably one of the most challenging career years of my life, because for the first time ever, I was faced with the realities of how the fund engine works in asset management. All the inefficiencies, all the lack of transparency, friction and complication. And all of that was previously hidden from me, because at Goldman and at the hedge fund I worked at previously, we had scores and scores of operational staff to take care of these things for us so that we could just focus on the investments. So after a year, I decided to shut this down and really try to take a year out and recharge my batteries. And I kind of was sitting on a beach doing just that, in 2015. And I came across an article on Bitcoin, and then that led me to Ethereum. And 5 years ago, I kind of thought, wow, Ethereum is pretty amazing, because what it opens up is the possibility to tokenize assets. And it's so much more efficient than how we do things on paper today. And why wouldn't, if you can tokenize, companies, ICOs, why wouldn't you be able to tokenize everything? And why wouldn't everything eventually have a tokenized share class? So that became my pivotal, aha moment, where I was like, okay, so if you have a future where everything can be tokenized or have some form of tokenized form, you could also automate all the pain points of finance into a in a smart contract based system. And so that was really the beginning of my journey. Melonport was a company I co-founded in 2016. We did one of the first ICOs, quite small actually, in February 2017. We built V1, or the first version of the Melon protocol, the completely decentralized asset management protocol, which enables anyone to set up a fund and customize it in a matter of minutes. You don't have to be technical. And also anyone to invest in that fund takes care of the NAV calculations, the fee calculations and distribution, all your risk management policies, et cetera, et cetera. So really the manager, all they really need to do is focus on investing. And that was really what I wanted to do, bring simplicity back to the manager and empower them.
And I think what a lot of people don't quite think about is, first of course, the journey of automation is nothing new. You don't have to be decentralized to automate. But the other issue, of course, is kind of platform dependency, because if you jump on a Goldman platform or a Boni platform, if the relationship goes sour, you're out of business. And effectively, what you've created is an unstoppable platform. Therefore, you just eliminate the risk of an asset manager that the platform that they rely on is going to be removed from under them. And I think that's a lot of the time people don't quite understand how vulnerable a business can be if they rely on a platform that's just whipped away from them. And it happens more often than people imagine. So I think that's for people who've been on the other side, that's pretty amazing. And be able, and through decentralization, you create enough trust that you don't have to have the big name of Boney or State Street or Northern Trust to operate that. So I think that's quite unique. Thank you for that. And I guess, Dan, love to hear your story and kind of how you came into this.
Yeah, sure. So my kind of career journey, I guess begins in a very classical way. After studying engineering at the University of Cambridge, I went into the world of business consulting, where I joined kind of like a leading consultancy firm here in the UK, and went into a whole variety of different businesses and kind of helped them achieve their business goals. And I got an opportunity to join Bitfinex, which at the time was kind of growing quite quickly, and could have used my help. And that's kind of how my crypto journey began. Then within there, I quickly moved into Edfinex, which was kind of a subsidiary of Bitfinex, which was started with the idea of exploring Ethereum, like basically only focused on Ethereum, exploring decentralized governance, decentralized trading, with the idea of that kind of blossoming one day. A few of us from Edfinex spun out and started what is now Diversify, where again, kind of looking into the future, Ethereum, one of its biggest problems was scaling, and especially for trading. Even 6 months ago, it was at times painful how slow the network was, and there were issues with privacy, which a lot of kind of big professional traders and institutions were just not keen on the fact that your trading activity is all public and people can reverse your algorithms and so on. So that's when we started thinking about how we can scale this, and eventually went with the Starkware scaling solution that we managed to launch the new and kind of shiny version of Diversify in June, which now allows us to be kind of abstracted from, not completely, but to a level abstracted from the congestion of the network.
Yeah, I mean, I think it's amazing because one of my personal hypotheses is the fact that, lack of trust creates fragmentation of liquidity. Yeah, because, you might say, for instance, I'm not going to trust more than X to particular exchange. You fragment your liquidity, but that drives your costs up because you're now managing rebalancing, you're actually kind of missing some of the trade opportunities, and you're not getting access to that huge liquidity. Then you go OTC because now you have to source liquidity, which adds the brokerage fees and et cetera, et cetera, et cetera. So in reality, if we get it right, then by significantly improving the trust relationships through decentralization, we can create massive liquidity pools that kind of effectively creates deeper and cheaper trading. That's kind of hopefully the game. Yeah. So I guess in terms of then, both of you went from centralized, whether it's traditional or crypto space, into more deeper into the decentralized. I guess just really love to say what you think you've done wrong so far, and we can, what are the insights about what we've learned we can do better. And then also, frankly, almost like, well, quite a few folks are now coming from centralized finance and they're unhappy with their returns right now and so on. They're like looking at DeFi and saying, this sounds good, but I'm a little bit nervous getting into it. Sell to me why I should go into DeFi, but don't give me all this BS around decentralization. Sell it to me as though it's a business proposition, unemotionally.
Okay, so first of all, I want to just make something very clear. There is a spectrum of decentralization, right? It's not that you are either decentralized or centralized. And there is also on that spectrum a trade-off. The more decentralized you are, sometimes the less efficient you are. Decision-making is slower. Results can be slower. And so it only really makes sense. The more decentralized you get on the other side, the more secure a system becomes, and the less subject to attack or malicious attack or failure. system is as well. So you need to think very carefully when you're looking at the space. It's not just, oh, you know, we're kind of at this one extreme. But I want to make it very clear is there's a spectrum, and it doesn't necessarily always make sense for everyone to decentralize everything. And so the way we have built Melon at its core is such that at its purest form, it is totally decentralized. But if you want to centralize certain components for efficiency or for you know, whatever reasons it might be, maybe you want to set up a type of fund that you know, needs to have certain regulatory conditions, and so you have to, you know, centralize certain parts of it. You can still customize it to be that way. In the asset management case, you'll know as well as I know that it typically costs at least $100,000 to set up a fund. And probably at least $75,000 of ongoing costs recurring per year to maintain just the basic fund administration, custodian costs, etc. So in terms of what a protocol like Melon could do is taking that cost to literally a couple of $100, its rawest form, of course, and then no recurring costs over that. You would just have to pay for trading, of course. So that's for me what was, I mean, coming from my fund failure, that was what was really exciting for me. Essentially, you democratizing finance, you're empowering people, you know, who love investing to focus on just the investing component. But it's, you know, DeFi is very composable. You can mix and match it with many different, you know, other protocols. You can, moving to your next question, which is, you know, what about the returns in DeFi? You know, a lot of them are irrational, I'm not going to lie. And some of them are rational. You know, there are some very exciting things happening. You know, you can earn yields which are not possible to earn on, for example, you know, you can earn up to 6% interest on a digital dollar, lending a digital dollar today, and you can't a decentralized digital dollar, which you can't do in, you know, in traditional finance.
Dan, same for your question.
So what's the most interesting, like, what is driving people to DeFi now? So, you know, as we already mentioned, you know, there is a lot of capital flowing into DeFi, and that is mostly prompted by big returns. Now, as always, you know, big returns come with certain risks, and you know, there is a reason why they're there. Now, generally, why there are such big returns in DeFi is basically because people are incentivized to use certain products, and you know, there is a level of hype there. There is there now. However, I think there are also a few positive things about DeFi compared to kind of hype cycles in the past. The first one being that there is a lot of hype around things right now, but it is generally all around existing products. So things are hyped, but that is because there are real things that work and they create some value. Now, you know, people speculate that value is higher than it is, maybe, but you know, it's not just a white paper. In terms of security, you know, I think, again, everyone has to do their own research before putting in significant funds into anywhere. But I think over the last year, DeFi has kind of matured quite a bit in terms of kind of like auditing practices, but also in terms of disclosing vulnerabilities. I think there's now an expectation in the industry of how these things are disclosed, rather than, you know, kind of people keeping it quiet and trying to, you know, hide the fact that there's vulnerability. There's a lot of there's a practice of openness, and that's almost expected, and there's kind of a bit of forgiveness if you do it in the right way. When we boil it down to where does the non-hype value in DeFi come from, and it is mostly around kind of the types of things Mona mentioned around cutting out intermediaries. So when we cut out intermediaries, a lot of you know, a lot of extra value is left to be taken by, you know, other participants in the value chain. So, you know, if you're not paying $100,000 for your fund, you know, those $100,000 are left either for you or for the investments you're making.
Yep.
Maybe, if I can just jump in, Alex, maybe as just a little cool analogy, you know, the way I sometimes like to think about it is Bitcoin was the first example of a public blockchain we had. And then if you think about Ethereum or the protocols in DeFi that are happening on Ethereum, you have things like trading, which, you know, Diversify are in, and that could be and when you're trading, you have a buyer and a seller, and normally you need a whole host of intermediaries to make sure that the buyer and seller, when they agree on a price, the underlying asset is exchanged. So you need the exchange, the guys that change the ownership of the transfer agent, et cetera. And now you can basically do that with a few lines of code, and the blockchain enforces that settlement almost immediately. With lending protocols, you have borrower and seller. And, when you borrow, you want to make sure, or when you lend, you want to make sure that the borrower is going to pay you back. And that's what those protocols enforced, without the need for, usually you would have a bank, a credit agency, etc.
Yeah.
And the protocol is really enforcing that process without the need for financial intermediary. So all of these, and asset management is the trust between the fund manager and the investor. So like there are parts where it's gameable and it might not work, etc. But generally speaking, the number or the number of tasks left that need to be monitored are greatly reduced, and therefore the cost of operating in theory should also be greatly reduced.
So thank you so much, Dan, Mona, for your insights, and thank you, Nisa. Back to you.
Next up, James Bennett is back for this week's On-Chain Reaction.
Hello and welcome to On-Chain Reaction. I'm your host, James Bennett, and I'm the CEO of ByteTree, applied data for digital asset investors. So this week, I'm going to walk you through some on-chain data, specifically looking at the mining industry. On the first slide here, we can see that miners over the last month or so have been earning around $11 to $12 million per day in revenues. This is really good news for the network after the Bitcoin, the last halving in May, saw the block reward drop from $100,000 per block to $50,000 per block. So despite the block reward halving, miners have been able to sustain a very good level of revenue, and this has been made up by an increase in fees. The blue line here shows a 14-day moving average of fees as a percentage of total revenues. We can see that it currently sits around 10%. Now, while this is positive for the long run in terms of creating an incentive for miners to be active on the network, it's slightly concerning from a usability point of view. In my view, it's good to see fees at around 2 to 5% of total revenues, but when we get to around 10%, it can act as a disincentive to users who might seek other payment networks like Litecoin or Dash in order to send their transactions. This is a metric we need to watch closely as time goes on. So we can see then that fees are rising and miners are able to sustain their revenues. This next slide here shows us the impact that has had on the total difficulty level of the network. Now remember, as more compute power is added to the network, the Bitcoin protocol, adjusts the difficulty upwards. So it's an automatic adjustment that's programmed into Bitcoin in order to make sure that block times are consistently around 10 minutes. And we'll come to that in the next slide. But before we do that, I just want to show you here in the dark blue line, we're seeing the marginal revenue that a miner gets every time they mine a block. So around every 10 minutes, this is how much a miner receives in revenue. We can see that that's been trending up since the May 20 halving and currently sits around $80,000 per block. Now, if your marginal revenue that you can earn is increasing, let's say ceteris paribus costs are remaining flat, then that means actually your profit margin is also increasing. And what does that do in a free market? Well, it encourages more compute power, more actors to come and compete for those profits. And that's exactly what we can see happening here with the difficulty level. Marginal revenue brings in more miners, that brings in more compute power, which then drives the difficulty up. And we're currently seeing difficulty hit all-time highs for the third or fourth time this year so far. It's really positive news, again, for the longevity of this space, because the Bitcoin network requires a very distributed and computer-heavy infrastructure to be in place for all the different applications that we'd like to use it for. So as we move to the next slide, we can see that relationship I talked about with block times. So the dotted horizontal line shows us where the standard, we call it a retargeting time, sits, which is about 10 minutes per block. Now that dark blue line that's overlaid on the dotted line is the actual block time on a 14 moving average basis. When we see periods that consistently seeing block times below that 10-minute level, it means new capital expenditure and operational expenditure is being invested into the network. And vice versa, when block times go up, so take longer than 10 minutes, it means people are holding back on mining the chain. That typically happens when revenues drop sharply, which is associated to price. So you can see there, the grey line is the Bitcoin price. Those two peaks in April, well, actually, I guess it was March, late March, and then June, when Bitcoin had some high volatility, negative price action, and miners went offline, slowing down the block times. What we've seen over the last couple of months since July is again positive. That mining power is increasing, and we're seeing block times remaining below that 10-minute threshold. Okay, so now moving on to the last slide, this is one of my favorite metrics to look at, because we say, what are miners doing with all of that excess inventory that they're building? So they're holding on to it at the moment. So we can see in this miners rolling inventory chart, the difference between what miners actually create, we call it generating, and what they send out for the first time. That's first spend. And you can look at these metrics live or read more about them on the Bytetree terminal. But when we're at 100% level, it means every new Bitcoin that's being mined or generated is then being sent out, let's say liquidated for cash in order to fund operations. But what we've seen in the last couple of months is an increase in the inventory levels, so that miners are actually holding a lot of that new coin on their balance sheets, which suggests that they're not in the position that they constantly need to liquidate it for fiat in order to pay for their operational expenditure. And if we look at the news that we're seeing, across the industry, it's this maturation of the mining sector that's allowing this to happen, because it's bigger companies able to hedge their position by selling their hash rate in advance or even forwards on the Bitcoin themselves. And that means that they're not in such a hurry to sell their Bitcoin. And that's exactly what we're seeing reflected here. Now, if you've enjoyed listening to this today, then please do check out the Bytetree terminal and keep an eye out for a big report that we've got coming up with Bitstamp in a couple of weeks. If you sign up to our mailing list, you'll be able to hear about that as soon as it's ready. That's all from me for now. Have a great week. Bye-bye.
Thanks, James. You've been watching CoinScrub Markets. Thanks so much for joining us. See you again next week.